Video number 4, buying puts. Hopefully you're getting the idea by now that there are two products. There are calls and there's puts, which gives us 4 fundamental positions because you can buy put calls, you can sell calls, you can buy puts, and you can sell puts. Okay, when you buy something, you expect to pay for it. When you sell something, you expect to get paid for it. A put is the right to sell if the price goes down. If you own a put, you own the right to sell something if the price goes down. Now, it's worth mentioning here that puts are a little bit trickier because you are buying the right to sell something that you may not necessarily own, which is different from a call. Okay, so options can be bought or sold anytime until expiry. Most options, they don't expire. They're sold, or the position is closed before the contract expires. That's a very useful statistic. Calls and puts can be traded without ever buying the underlying stock. Obviously, as an extension of this, you never have to own CBA shares, ever. You can trade options on them all day and never own the underlying stock. Core concepts remain the same. I won't repeat myself here. Examples. If we bought a put in February with a $110 strike price, February, $110 strike price, we have purchased the right to sell something at the strike price if the price comes off, which by April it well and truly has. This example paid off. We bought something that gave us the right to sell our stock at $110 if it came off, which it did. It came off down to $100. So we now get to sell CBA shares for $110, even though the market tells us that they're worth $100 each. Okay, now in this example, if we did not own the stock, how could we sell it? There's 2 options here. One, we can let the contract expire and we can buy the stock at $100, then on sell it as per our contractual right for $110. Or, as we knew the expiry was coming up, we could just sell it before it got here. In fact, we'd probably sell it down here, because then we'd be cashing in a $16 difference as opposed to just a $10 difference. Example number 2. If we bought a put in March with a strike price of $95. Okay. We're betting that the price will come off. We have bought a contract that enables us or entitles us the right to sell if the price comes off. It did not. Okay, unless you count here or here, but as per the chart, the price has gone up by late July. Our contract would expire worthless. We bought a contract that it entitled us the right to sell something for $95 if the price came off. It didn't. We wasted our money. We bought a contract that expired worthless. Third example, if we bought a put in mid-August with a strike price of $104 and a 3-day expiry. That's this example here. So perhaps we knew that the dividend was about to be paid and we were expecting this gap. This is a legitimate, tried and tested trade, by the way. We bought a put in mid-August. We have bought a contract which entitles us the right to sell our stock for $104 if it comes off. It has come off. It's worth about $99.50. So in this example, we get to sell stock for $104. That's trading at $99.50. Okay. Again, if we didn't own the stock, we would sell the contract before it expired, or we would buy it at market and then sell it as per our contract for $104. Example number 4, we buy a put in late October with a strike price of $96. $96. We buy a put here because we expect this downtrend to continue, maybe, whatever. In either case, in late November, the price has gone up, our option would expire worthless. Whatever money we spent on that option is gone. Somebody got our money for free. Next example, if we buy a put in early April with a $99 strike price and a 2-week expiry, would it expire worthless or in the money? Early April. $99 strike price expires in November. Okay, that's a really, really long expiry. So we bought it in, we bought it in October. We bought in late October with a $96 strike price. Which example are we doing here? I've messed it up. Ignore that statement. If we buy a put in early April with a $99 strike price with 2-week expiry, that's about here in mid-May. $99. We would probably sell it early. We would sell, if we bought the contract here and it had a 2-week expiry, it's dipped off down to $96. We're probably going to sell that down here somewhere because that's a fairly quick come off. Quick come offs usually have a bit of a bounce going on. It's like this one over here that bounces back. So we're probably going to sell it down here. But if we left it to expiry, it'd be worth maybe $1. It might not even be worth actioning that contract. So it expires in the money, but we probably wouldn't let it wait that long before we close that position out to take profit. Would a put bought in early May with a $96 strike price expire worthless or in the money if it expires in mid-June? Would a put bought in early May? Early May, $96 strike price. The price doesn't really get below that, so we can probably assume it expires worthless. But let's do our due diligence. Mid-June. It could possibly expire with a couple of cents worth on it. But we can probably just assume that it's largely worthless because we're only going to get a couple of cents out of that. It may not be worth our money to have that actioned. There are 2 products, 4 fundamental positions. We've just covered buying puts. A put is the right to sell if the price goes down. Puts are trickier. You are buying the right to sell something that you may not necessarily own. That's okay. You can still let it expire. You don't have to let it expire. You can sell it before it expires.